Hi there. Boohoo, very popular stock, have just released their final results for the year ended the 28th of February 2023. So let's put them through the spreadsheet and see what the results actually look like under the hood, or maybe under the hoodie. It's a fashion thing. Okay, Boohoo at 43 pence. They have a market cap of 488 million, enterprise values of 482, which means they have more cash than debt, which is a good sign. Okay, net asset value of 400 million there. Average daily volume on this, by the way, is 3.4 million if you're interested. I look at that for smaller cap companies, micro caps, to see, how much is safe to take to invest in, because if you're investing in too much and you hold more than the average daily volume, it's not good. And I look for a margin of error of 10% as well as that. Anyway, revenue, let's look for this is for the year of 1.7 billion. Operating loss of 82 million. Now, if we look at the interims, we can see there that a loss of 11.8. So that increased in the second half substantially, the loss. Cash of 330 million. It's gone up slightly from 314. Debt of 325 is the same at their interim, so cash has improved, debt stayed the same. Operating cash flow of 136 million, so that's better. They're collecting more cash there from the operations, from 42 million. And in fact, at the half-year point, they were negative on the free cash flow, whereas now they generated 33.4 million of free cash flow. Okay, growth, and I always put these through these kind of metrics: growth, value, health, efficiency, momentum. Okay, is the 5 metrics I look at. On a growth level, top line down 11%, operating profit are also down substantially, but it said operating cash flow and free cash flow up. And we're looking at price to sales on the value front, a decent 0.28. Price to earnings is negative, of course. It's gone down. Price to book, it's just over net tangible assets. And price to free cash flow, not too bad there. And it has improved, like I said, from the interims. And in fact, if we compare this to Assos last week, that was a lot different. Assos, I mean, they are having a lot more debt, 740 million of debt. And the enterprise value is a lot bigger, of course, and also they're negative on the operating cash flow and free cash flow. So Boohoo, to me, looks in a better position right here. We'll compare the scores in a bit. Health-wise, increased cash, 229 million. Okay, so now in a net cash position of just shy of 6 million. They were a net debt position of 10.4. So current ratio is good. That means, of course, their current assets cover their current liabilities. They're nearly there on the quick ratio, which is a high bar to hit. So health-wise, they're looking okay, apart from, of course, if you have debt and you're not generating cash or from operating level, there's a problem servicing that debt. But they do seem to be improving. Now, let's look at margins. Are they suffering? The cost of living crisis, of course, has gone up. Shipping has gone up. And their margins, their gross margin has gone down from 52 to 50, as you can see there. And on a momentum level, as you see, look at the chart, it's not looking very good. I mean, if you look at this, look at the moving averages, it's come below this. And it hasn't even pierced the 50-day pretty much since when? July 2021. It tried to break above it a couple of times here, false breakouts. And we've seen recently a break above not only the 50, the 125 and the 200, but now we're below that. So, of course, this is now rolling over. So I'd still say we started maybe to see the ending of a downtrend, but it's now breaking down again below that. So there we are. So it's not looking very positive on the momentum. So let's have a look at the forecast. So I've got this from Stockopedia pretty much, and there's very little growth, as you can see here, going 2023, 2024. And in fact, I've been a bit optimistic and penned in increasing sort of margins. But this is what you're looking at. Now, you can achieve the following returns. Minus 62%. Based on the operating loss and the margins now, and I've improved the margins, but these are the margins. Their revenue growth of 1% in 2024, 1% in 2025, based on an amalgamation of the margins of EBITDA 6%, pre-tax profit 2%, and a post-tax of just under half of 1% on these multiples. This is the return you're looking to get by 2025. And that's just based on those margins. If they do improve that, if they get top-line growth, of course, then that would improve. That's assuming they basically got 1% growth next 2 years and gross margin 50, EBITDA margins 6 to 8, improving that way. So there's not a lot of return there unless they significantly improve those margins and improve the growth. Hope that helps.